Hello everyone, my name is Fredrik Weisseneder. I will be holding the webinar today. With me I have my colleagues Jacob and Olivia running the show. I'm just here talking. I'm the founder of our company. We started more than 25 years ago as strategy consultants within Capexes and Capex Strategies. We have worked for the capital-intensive industry for all these years, mainly pulp, paper, packaging, also steel, metals and mining, the food industry, nuclear, and so on and so on. So today we're going to talk about how you answer the question, where should we invest, in what, when, and how much? Okay, so this is, I'm not going to go through this picture here, but this is a typical capital allocation process in companies today. You register a Capex request somewhere in a company, you process it, you prepare it, you analyze it, you add lots of documentation, you pass it through the chain of command in the company, you get your decision, execute, you monitor it, you make sure that it follows its budget and so on. Then you hopefully have a post-completion review at the end. Parallel to that process, you have a capital budgeting process with alternative multi-year budgets or whatever you might have. You get a budget decision, etc., etc. So many years ago, we decided to, since we know so much about Capexes, we decided to develop a tool around this. So we have a tool that takes care of all this. It's a purpose-built, web-based tool that is used by several of the larger companies in Europe and the Americas. But we're not going to talk about that one today. We're going to talk about what should be running the show in companies, but that doesn't typically. And that is this Capex strategy level, which is a level that should govern the capital budgeting and Capex management process, because these processes, capital budgeting and Capex management, they cannot answer questions. Where should we invest? In which mill? In which business? In which country? Or in what? Or when should we do this? Or how much? That the process that you have here in the bottom two swim lanes, they can't simply answer questions like that, but those processes are used for that. These are some of the companies that over the years have used our tools. There are several more. You probably recognize some companies, steel, pulp, paper, and energy, production, packaging, etc. What I'm going to go through now is, first of all, what the issue is with today's way of allocating capital in the industry. That it's simply not working today. Companies believe they're making great decisions, or they believe they're not. Whatever it is, whatever they're doing it all wrong. And it's not about that they use internal rate of return instead of net present value or payback. It's not at all at that level. It's something completely different. And that is what I'm going to show you today. And what I'll do then is that I will quickly also show how you should do it. But it will not be able, I won't be able to go into detail, of course, today. So if you want to know more, you just contact us in one way or another. So I'm going to simply jump into my presentation. I know from experience that is how I should do it, so I'll do that. This is a presentation that I've held 400 or 500 times or something like that. And it usually goes well. So let's see how this does today. If we say that we have a mill, a plant, that we've had for a number of years, like 10 years or 20 years or something, historically, it's been making money at a certain level. Of course, it's very volatile in reality, but let's pretend we could normalize that level. And we are here today. And we could say that this plant, this mill, will continue and make money at that level. Again, it's going to be very volatile, but if we normalize it. At some point, will the mill manager come to the headquarters and say, sure, I'll make money like that, no problem at all. But to do that, I need to fix my quality issue that I have. I'm getting more and more complaints. I have to give up better or worse rebates every time. So I need to spend some capital to fix this. I'm going to move my picture here. I'm going to spend some capital to fix this issue, and then I'll make money like that. So if I get my investment, I'll make money like that. If I don't get to spend that capital, I'm going to be making money at that level instead. And I'll now assume, just to make life very simple for us, that all data, all the assumptions, those are correct. So this is the amount of money we will be making from this mill if we invest. This is what we'll be making if we do not invest, and this is actually the Capex amount. In reality, we don't have that luxury, but in this picture we do. Okay, so we say yes to this Capex. It makes sense. It has a 2.5 year payback, so we'll just go ahead with it. The next quarter, the mill manager will again come and say, I have this issue, I need to fix it, otherwise I'm going to be making money at that level, and this has a 2.5 year payback or 3 year payback or something, and this will just continue into the future. And let's say we have 10 products here. We're at the today line. We could say that this is our Capex budget for our mill over the next year or 3 years or whatever time perspective we have. So we put those in a Capex plan like this with our net present values, and we summarize them to 200. Now, this is where things are becoming really interesting, because what's interesting with that number 200? Well, first of all, mathematically, that number 200 is completely disconnected from the value of this mill or from the performance of this mill. There's no connection mathematically. Most of us would believe that it had, but it has no connection. The value of the mill is determined by where this green line is. If it's up here or down here, that's the value of the mill. But the value of this Capex plan is not determined by that. The best example of it is if we say that this here is our B mill. Okay, so I'm going to add an A mill. I have here my B mill. I'm also going to add a C mill. Right down here, that's the C mill. We have the same products in the C mill that we had in the B mill. Same paybacks, same everything. What is the value of that mill's Capex plan going to say down there at the bottom? Okay, so we have the same products. That's also going to say 200. But this is a mill that has zero cash flow. But the value of the Capex plan is still 200. Because the value of the Capex plan is the total of all these individual projects that we have here. And the value of those are not determined by where that green line is, but by how bad things go if we don't invest. So it's the delta between the dashed line and the full line, not where the full line is. And we can also add an A mill up here, this great performer making lots of money, state-of-the-art stuff. It's also going to have 10 products with a total value of 200. Again, the value of the mill is not 200, the value of the Capex plan is. Now, if you remember the first picture I showed you, one of the first with the 3 swim lanes, the middle one was capital budgeting. This is a bit confusing to the capital budgeting process because we have 3 performers that are very different here. And in this company, it's really easy. We only have 3 mills, but some companies have like 300 mills for plants. Then it gets really confusing and difficult to understand where you should be allocating capital because they all seem to be returning the same amount of value. They all look like they're performing well. So in real life, things are unfortunately a lot worse. Okay, because they will not have the same Capex plan value of 200. Because what's happening here, and now I'm adding down here, I'm adding a line. Because the reason for why a mill is down here is usually because it's not state of the art. The equipment is aging. It has more issues. You have more things to fix. So you will come to the headquarters and say, not only have you 1, 2, 3, and all these products that the other mills do, but you also have like 1B, 2B, and so on. So you're going to be adding products to that list, and they're all going to have a great payback, so no question about the performance of each product. Not only that, but when you fix something in a C mill, you fix a larger problem. And if you fix a larger problem, you will have a faster payback, you will have a higher net present value. And I'm illustrating that by letting that green dashed line not fall like that, but instead fall like this, creating a larger gap, a higher net present value, and a faster payback. So this mill will not, in the capital budgeting process, have a plan, Capex plan value of 200. It's going to be, a lot more. It's going to be something like maybe 400. And while B is maybe looking the way it does and it looks fine, the A mill, well, they don't even have all these issues, okay? And when they have an issue, they're not fixing a very large problem. So their dashed lines will not fall as dramatically. So they're going to come to the headquarters and say, oh, we have our budget here, it's averaging 5-year payback. They can't compete in the race for capital, but the C mill, they can, and also the B mills. And this is really confusing then if you have a capital budgeting process that seems to tell you that you're making money where you're not making money, that you have your values where you're actually not performing at all. And this is how it looks in the world's 100,000 largest companies. This is how the capital allocation systems are indicating how things should be allocated within the company when it comes to capital and all other resources. Okay, so one example where things can go really bad, too many companies, packaging companies, steel companies, it's paradise now. Life has never been better. And they often also think, of course, that life is going to go on like that. It's a new world and so on. But what do we know about new worlds like that? Well, they never last. So at some point, we're again going to come into an economy where things become bad. So the following example is about that. Companies, they typically spend something like 75% of their resources in B mills. That is usually how it looks. It seems to be the same across different industries. It seems to be the same in whichever continent you're on. Let's say this is a budget that we have here. What happens to that budget if things go really bad? If packaging prices are down 20% and same with steel prices and everything, what happens to that budget then? Well, the Capex budget becomes smaller. A poorer economy means smaller Capex budget. And what else becomes important when things go bad? When the EBITDA margins are down and your cash flow becomes it's under pressure. What is more important than? Well, liquidity. So you want paybacks even faster than maybe the average 2.5 to 3 years. You want it to be faster than that. Where do you find faster payback projects? Well, you find them down here, especially down in C mills. So while many companies will understand that we cannot invest in mills or plants that actually have zero cash flow. Many companies will understand that, many will not. But they will still be investing in sort of the low Bs. And what I said earlier was that the paybacks, all the assumptions that we have in all these lines here, all the data is correct. So while each product that we see in the C mill will actually return that, let's say, 2-year payback that we have, you will actually never see that money because it's a zero cash flow mill. So you will have paybacks coming in 2 years, 1.5 year, 3 years, 2.5, they will all be realized. You will actually see all the assumptions being fulfilled in all these projects, hopefully, but money you will never see. My personal opinion is that the term payback should be banned globally by UN or somebody having that type of responsibility, which they don't, but still, you get the meaning. Because that payback, it's not about payback. You never see payback. Payback is not something that actually happens, okay? And you can understand that by looking at a C mill where you have realized project after project, you fulfill all the assumptions, but money you never see. So we have our three categories here, and now I'm cutting my ordinary presentation a bit shorter because you don't want to spend 90 minutes with me. So I'm going to jump a little bit now into a table that when I start my strategy projects, I usually let the product teams and the steering team, they fill this table in. It's a fun exercise, and it's also very rewarding when it comes to all the discussions that pop up when doing so. So when I kick off the projects, this is part of what we do. So if I have my three categories here, A, B, and C, and we talk about CapExes, we talk about cash flow after CapExes, and something that I call MA at this point. I'll get to that in a while. So we're going to fill this table in by answering a few questions. And you can imagine the answers yourselves. I'll give you them. I'll give you the answers today, and if we meet, you can tell me what you think about it. Okay, so my first question is, in a normal year, in a normal company, in your industry, how much out of the annual Capex budget will typically go into the C mills? And the C mill is being defined as a mill that you know that you're going to shut down at some point, but you don't have that decision, okay? So it's not a decision yet, you just think that next time we need to take out capacity, that's the one that goes. How much do you invest? Well, you like to say 0%, but that's not going to be the case. It's around 5%. Sort of like something like 3 to 8% of the Capex budget goes into that C mill, which is usually 1 out of 10 locations that you have. So how much do you spend in A mills, A plants? An A plant is closer to state-of-the-art technology. They're performing really well. They don't have environmental issues. They don't have safety issues. They don't have quality issues. They just run. They're usually, in the average company, they're sort of like half of the capacity, okay, in the average company. That and 3 out of 10 mills, but maybe half of the capacity because of the difference in scale. They get something like 20, sometimes 25% of all the capital that's going on. So if you have 10 mills, you'll have one of the mills, which is a C mill, that gets 5%, 3 of the mills get 20%, and the remaining 6 mills will get something like 75%. To no surprise, they are aging, they are becoming less and less competitive, and they do have these quality issues, they have safety, environmental issues, and so on. So they need more capital, especially if you look at it by SKU, by ton or cubic meter or whatever it is you measure. The next question is, if you look at the next year, 10 years cash flow, you can look into the future, 10 years. How much of your cash flow will come from each one of these categories? Well, if we have 10 mills, again, we have 1 mill over here, that is a C mill. If we are really lucky, that's going to say 0. Then we are really lucky. The A category, 50% of your capacity, consuming 20% of the Capex, high EBITDA margins, if you compare to the rest, they will provide you with something like 80%. Okay. And the B category, after having consumed 75% of the Capex, will then produce something like 20%. These are average numbers. When it comes to Capexes up here, while these seem to be almost like true for all industries, wherever we go, companies seem to gravitate into this distribution of capital. If you don't recognize yourself in here, it may be because you don't have the distribution that I've talked about between A, B, and C mills, like 3 here, 6 here, and 1 here, okay? 50% of your capacity here and 50% of your capacity here. That's sort of the average distribution in the industry. So while these are very true numbers wherever we go, these are not, because they go up so much from company to company. We had a project a number of years ago. I think we had 6 or 7 mills in that project in North America, where we spend most of our times in North and South America. They had 130 or 140% in their best mill out of 6. So you can imagine the average of the remaining 5. That was then below 0, obviously. Okay, so the last one is management attention, MA. So if you pick your companies, depending on how large you are, your company's 100 most important resources, where do they spend their time? Your experts, your go-to persons when it comes to engineering, market, sales, HR, whatever. Yeah, I actually have a question here. If we see them within mining and metals, definitely. No question. No question at all. But again, if you don't recognize yourselves, it might be because you don't have these type of distribution. I can tell you from having worked in pulp and paper so much, there are whole companies that don't have a single A asset. They only have B and Cs, and then they will complain and say, no, no, we don't distribute capital like that. No, you don't, because you don't have these type of assets. And by the way, what do companies that only have B and C assets do? What do they typically do? Well, they buy another company, they acquire another company with B and C assets, wasting all their money so they don't have any capital left to fix what they have. And then they go bankrupt after a while. Okay, so we definitely see these numbers across, in the food industry, we see it. We see it in nuclear industry. We see it in pulp, paper, and packaging, lumber mills, sawmills. We see it in metals and mining. Yeah, wherever we go, basically. And the type of studies that we do, we've done the same type of studies for more than 20 years. We keep repeating our strategy products across these industries. So we look at industries in this with the same type of glasses every time, if you see what I mean. Okay, so management attention. Again, where do your experts spend their time? Well, so this always creates a lot of discussions. In the C mill, how much of your experts are being involved in what's going on in C mills? Well, the average percentage here, it's a bit shocking to me, but it's around 30%. 30% of the most important resources are being sort of directed to where the biggest problem is, generating nothing in value. Okay. How much time is being spent on the A category? We had a product again, that was North America. I remember it so well. We had a product in North America involving, I don't know, 20 mills or something. That was 10 years ago. And the product lead from the client side, he was a really experienced guy. He had been the mill manager of that company's prime assets, prime asset, an A mill. He'd been there for 5 years. And he told me, when we drew this table, he told me, and I had to check this story with him. He retired a few years ago, so I actually set up a breakfast with him where he lives in the US. So I went to visit him because I had to check this story for just my memory, being a ghost to creating things, or it was actually true. Because he had claimed to me then 10 years ago that over the 5 years that he ran that mill, he wasn't contacted by the headquarters even once. The phone was quiet for 5 years. Why? Well, they were elsewhere. Okay. And he confirmed the story. That is exactly how he claims it was. The phone was quiet for 5 years. So that category gets something like 5%. Again, they don't have issues. They don't have safety, environmental, quality, equipment, or anything. They just run. Okay. The B category then gets 65%. And while I can explain why this table happens, I understand it. If you have your company's future somewhere, but spend your resources elsewhere, well, then you're in big trouble. Eventually you're going to run your company into the ground, or at least you're going to be struggling so much with your margins, with your cash flow, and it's just terrible. And why do companies end up in this allocation of resources? Because it's a global phenomenon. It's a global plague, rather. Well, there are a couple of very strong reasons for it, and we actually already mentioned it. But at the end of this, I will tell you how to read more about it, because we have a text on our website explaining everything a lot better than I'm going to have time to do today. But first of all, the capex process is a bottom-up process. It's the mills or the plants or maybe the regions, if it's that type of that type of business, uh, that go to the headquarters and say, I have this issue. And then the headquarters is going to say, oh, yeah, we know. I mean, you've been coming here for 3 years saying the same thing. So they all know about this stuff. Okay. So the issue is clear. And then they put all their assumptions into a capex calculation, which is simply going to show to them that if they don't fix the problem, it's going to get even worse. So they get to this 2 or 3 year payback. And after time goes, if they don't invest, that calculation is going to be looking even better and better every year, because the problem becomes bigger and bigger, and eventually they get the approval for that capex. And the third thing is that, and this is, you see where the resources are being spent. Really, it's in the B category. What happens from a P&L performance profitability point of view in a B mill? Well, a B mill, those assets that are written off, they have basically nothing in the balance sheet. They have some billings, they have some reinvestments in there, but basically it's gone. And the EBITDA margin is maybe not all very good, but compared to the balance sheet, it's fantastic. So if you calculate your financial performance using anything based on P&Ls and balance sheets, like return on capital employed or whatever, or EVA, it's total confusion, because these measures are going to tell you you're a great performer, but you're not. Okay, so the problems, they are very obvious. The payback is fast. And by the way, we have a 16% return on capital employed, and you want to defend that, don't you? All flags are green. Okay, in that enormous category that we call a B category here, which is a what do you call it? Just like a black hole sucking all the capital and other resources in. They are saying that, well, it's great, everything is just great here, just keep giving us money, but they don't return any. They average maybe 20%, but we see in many companies that's actually even below zero. The money comes from somewhere else. Okay, so this is the short version. Again, we have a text, and I'll direct you to that in a little while. I'm going to shift and talk about the same thing, but from a slightly different angle. So this is today. That's what we see here. This is 40 years ago. I started working here somewhere. And I was in university in the early 90s, corporate finance, economics. I've always been a skeptical person. I don't really just believe things that people tell me. And my professors, they told me a lot of things that I simply didn't believe. And so when it comes to capexes and performance and all of that, and I wanted to write my master thesis on that, but they didn't allow me to do that. So I wrote it on some capexes and just a lot about capexes. But then I did have a few sections there on why actually nothing worked. Why things didn't add up, and why nothing really connected. Okay, so I wrote my thesis partly on that then, and then I had some more classes to take before my master's degree, and then in the summer of 1994 I was going to take my degree in June 5th or something. And what was really interesting in Sweden in 1994, I don't think we have any Swedish viewers today, but anyways, in 1994 in Sweden, nobody got a job. It was chaos, so everybody that I went to university with in our economics class, we were going to go out in unemployment actually. But the evening before I was going to go out, take my degree, I get this phone call on my landline, 1994. And it was this Swedish pulp and paper company who said, we read your thesis and we have a product for you if you're interested. We have this mill. Every year they show us a capex plan where the average internal rate of return is 40%, which is good. Okay. And they basically deliver. If they say they're going to take out 3 people, they do that. If they say they're going to improve the specific electricity consumption. They do that as well. So check on the 40%, no problem. Over the last 15 years, they have averaged a return on operating capital of 27%. Fantastic, right? So this great quick payback, return on investments, great return on assets, but something doesn't add up here. So we have looked at something else that you talk about in your thesis. Remember, this was more than 25 years ago. They said, we have looked at the cash flow from this mill over the last 15 years, and that has averaged zero. So the cash flow was zero, while all these other measures were just so fantastic. And what they wanted me to do, they wanted to give me 4 months as a project. And they said, can you just explain to us what has happened here? And they asked me, can you do that? I had no idea how to do it, but since I was facing unemployment, I said, sure, I'll do it. I know how to do that. So I took that project, and since then, I have worked with these issues without any interruptions. I have worked with these issues now for 27 years. Working with the same thing, actually. And it took me only a month or so to actually explain to them what had happened. And it was actually what I've been talking about today, that you can have a mill with great performing decisions, great performing business in the books, in the P&L, but it's completely dysfunctional because it's not making any money. That's just math, explaining that gap. So 40 years ago, I'm going to explain this now from another angle. In that project that I did that summer so many years ago, I interviewed a guy because I didn't really know where to start. So I started out interviewing people in that mill. And I asked that guy, what is your philosophy in your mill when you apply for Capex? And he said, well, we are investing according to the going concern principle. And I had to ask him what that was, because I was not in accounting, I was in finance. And in finance, that is not a term. That doesn't exist there really. So he explained, well, we invest to make sure that we continue living, that the mill sustains, okay? And I thought that made sense. 4 years later, in 1998, I realized that was a big problem in the industry. That is why things go wrong. In Sweden, 40 years ago, if you wonder why I had this picture up, in Sweden 40 years ago, we had about 110 pulp mills. And now we are down to approximately 30 pulp mills making fiber pulp for paper, So we've gone from 110 to 30, but these 30, they make like 2.5 times as much pulp that these 110 did 40 years ago. So while the business has been booming from a volume point of view, the number of locations has dropped dramatically. And why do you close 80 mills in a country like Sweden? Well, believe it or not, in contrast to what many people believe, Sweden is a market economy, and we are a truly capitalistic country when it comes to making business in Sweden. So these arrows, they represent pulp mills in Sweden. And why do you close 80 pulp mills in Sweden then? Well, there are only 2 reasons. One is that there's a real price fall in pulp. It's slow, and pulp prices are very volatile, but prices are going down. Sometimes that is debated if that really is going on, but that doesn't really matter because prices are down at least against costs that go in to produce pulp. So costs are going up. That means a declining margin. So you always have this margin pressure in all these mills, and most mills could simply not survive that. In Sweden, we think this is fantastic. In Sweden, not even the labor unions really fight this any longer because they know, everybody knows that this is how you build a country, by making more with fewer, with less resources. It's great. This is what we actually want to accomplish in countries, okay? We want to have this pressure. But doesn't really work for companies if the corporations don't see this coming, because they don't. They treat all their businesses as going concern businesses. They treat all their mills and plants as going concern, as if they were going to live forever. And that doesn't work. And they allocate capital not according to that, but actually tilted towards the mills that will not survive. And we started seeing that a number of years ago, that in the period that I indicate here, sort of like 3 to 5 years before the inevitable closure of this location, corporations invest a lot of capital into that mill. Why? Why do they do that? Well, they don't see what's coming. Because, one, the issue that they're looking at, it could be, a piece of equipment, or it could be anything, that is an obvious issue. Okay, it has obvious problems. Two, when you calculate on that problem, you're going to see that it has a 2-3 year payback. Fantastic. And by the way, it has a 15-20% return on capital employed, or whatever it is you're measuring, or EVA that is positive, or whatever. Okay, all flags are green. Everything looks so fantastic. Who's going to stop that capex? Well, maybe somebody with a gut feeling, but if you're a large company with 30 plants or 300 plants, you can't use gut feeling. You need to trust and rely on the system, but the system doesn't work. So this is what's going on in companies. They keep investing where they shouldn't, and they do not invest where they should. So what are companies going to do in the future? Because this is simply going to continue. Are they going to keep investing where they will not sustain, or will they do things differently? Now, we have worked with clients for many, many, many years, and we have fantastic references. You haven't even seen the major ones on the list. We have enormous references, and they all confirm what I've now just said. I'm going to jump a bit now and simply just try to summarize a bit before I go into how companies should view capital allocation instead. Well, as my summary is the following. If a capital budgeting process or Capex decision process in any way at all favors short paybacks, then capital will be allocated where the result becomes lowered company cash flow. It is even so that if you have a budget today for 2022, for instance, a Capex budget, and that averages, let's say, 3 years, and then somebody says, your CFO comes to you and say, no, it's not good enough, bring it down to 2.5 years. Doesn't that sound like something good? It's to me, it does. Wow, what if we could accomplish 2.5 years? That's great, isn't it? But what happens then is actually, while you're shortening the paybacks in the Capex budget, and now I still assume that all your assumptions actually will be realized. Okay, so the 2.5 years, that is a true number. You shorten it from 3 to 2.5 years. You're making your company worse, because your company cash flow will actually go down. That is so counterintuitive, but that is exactly what's going to happen. I can prove it, and I have references that will confirm. Even if you identify A, B, and C mills, okay, that might be a small and possibly useful step, but that does not assist the company when allocating capital. Knowing your A, B's, and C's is more of a mindset. It is not a plan. A great plan for allocating capital identifies the package, the best combination of decisions that will provide a company with improved competitiveness. An improved competitiveness that is increased, maximized long-term cash flow. And of course, considers short-term restrictions. So you cannot look at decisions in isolation. You can't do that. Then things will go wrong. And they have gone wrong for 3 decades. Okay, in your company. You need to look at everything as one holistic picture and work with that instead. And I'll show you in a little while how that can be done. Okay, so you may think, well, if we're doing what's blue here, won't we accomplish what is in pink here, or in violet maybe? Okay, no, you don't. They are completely in contrast to each other. They don't fall in line anywhere, okay? if you try to do what's in blue, you will completely fail the pink one. And if you do the pink one, well, then paybacks are going to be all over the place. They're not going to be short. They're going to be anything. Because what is a little bit of a problem is that it's not at all that you should choose long paybacks either. What I'm saying is that paybacks or net present value or internal rate of returns and so on, they are unfortunately completely irrelevant. That is what I'm saying. It could be 2 years, it could be 10 years, it could be never. The thing is that that doesn't matter. And that is one of your major problems, because your entire Capex budgeting process is based on that. When you talk about what's good and bad when spending capital, you talk about paybacks, net present values, etc., etc. I'm claiming, and I can prove it, that those measures, even if they are correctly calculated, they are completely irrelevant. They have zero value in the process. And this is being further explained in that text that we have on our website. We call it The Tail Wags the Dog because it's explained there. I won't be spending time on that. And we have it in English, Spanish, Portuguese, and German. Okay, so just go there and you'll find it. I'll continue. A great plan is created from studying, analyzing, and discussing many possible whole company capital allocation scenarios. You must always look at the whole company at the same time, not into isolated decisions. A great plan is tested in sensitivity analysis. A great plan is brought forward by a company's cross-functional team of experts. And it's characterized by random Capex paybacks. They're completely all over the place. Why? Well, because those are irrelevant for creating company cash flow and value. That's kind of disturbing, isn't it? Because when I went to school, my professors told me, oh, high net present value of your investment calculation, that's what we all did. To me, that didn't make sense, okay? It didn't make sense at all, but that is what was being taught in universities. This is how all companies do it. But if you read that text, The Tail Wags the Dog, you will understand that doesn't work at all. It's a completely irrelevant process. You still have to go through the process as such, though, because you need formally to have the approvals, okay? The board and your CEO, all of that, they need to do that. But to understand where, when, in what, and how much you're going to be spending your capital, then it's a completely irrelevant process, unfortunately. Okay, so I don't know if you have noticed, but I haven't said a word about really of how you should be doing things. So I'm going to give you now the crash course in how we do things. It's been applied on the major companies in the pulp, paper, and packaging industry for 20 years, metals and mining over like 5 years, and so on. And we keep plowing through industries as fast as we can. We do the following in two ways. We either implement this process with our tool that we have developed, a purpose-made tool. It's not Excel. Excel doesn't work. We gave that up a number of years ago. So we developed a tool instead, and that's being used by a number of companies in the Americas and in Europe. So we either implement this, or we go in and do this as a product and deliver a result, okay, to the CEO or whoever brings us in. It's typically the CEO or the COO that brings us in for products like that. Okay, so I'm going to show you now a timeline. I'm going to show you things so you can probably figure that out since it's empty here. I'm going to fill this now with some stuff. What you do first, over 4 to 8 weeks, depending on, you create a base alternative, and it's a starting point of this process that needs to strictly follow a number of rules. Okay, you have to do this in a very certain way for things to work. What you do is that you create a forward-looking cash flow statement, basically, maybe looking 20 years ahead, 30 years ahead or so. Then we have a process that we call asset mapping, where we go through the entire asset base and identify the long-term Capex need, 20, 30 years into the future, again, according to a specific process and rules that we made that you need to follow for this. Then we have a specific, it's very specific how we do this. But what you do is that you end up with a base alternative for each mill, So it's done for each mill, and then you aggregated it to the division or to the group level, corporate, whatever. And that's your starting point. And then what you do, you go to the steering team, which is your leadership, and you show them the base. Then the leadership lists a number of strategic opportunities. For instance, we call them strategic building blocks. For instance, debottleneck projects, new capabilities, and so on, shutting lines, shutting mills. One rule that we have is that in separate building blocks, every location that you have is being shut down. Everyone, even the favorite ones, are being shut down. It's a great way of approaching the strategy process, because once you've done that, anything is sort of possible. You remove barriers, mental barriers in the organization. And you look at new lines, green fields, any type of thing that is actually a large capex, basically. What's really important is that you look at opportunities here, and you don't think about much, what is really good and what is bad, because you don't. Because you're being colored by thinking that paybacks are good, that debottleneckings, they have to be 3-4 year paybacks for them to be good, and so on. You have to sort of get away from that, because that is irrelevant. You don't know what's good. You just need to list opportunities, okay? So if you have, let's say, 10 mills, you should have at least 50 opportunities listed here. Then what you do is that you start combining these building blocks into what we call strategic alternatives or strategic combinations. For instance, you shut a line and you build a line somewhere else, and you debottleneck a third line. That's a holistic, a very simple way of explaining a holistic alternative from a company point of view. That has major effects, because that doesn't mean that you are usually only affecting 3 mills, okay? You might affect all 10 mills that you have, if you have 10 mills, because of all the rotations of products and so on that you have here. And then you make another combination and another one. And also note that this is not an optimization that you're doing. You do not have a tool here that optimizes this and make sure that you find the best alternative. It's not an optimization tool. You have your experts sitting down and making these combinations. I'm not going to show you that today, but what you actually do in the tool is that you have all these building blocks listed, and then you simply say tick, 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 enter, and then you're done. Then you have these combinations. And then you go into the next one, say tick, 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 enter. So to create these combinations takes less than 10 seconds. And you can keep going like this, making combination after combination. And the highest number that I've heard in a product was 750 combinations, manually made, okay? With the absolute best resources in the company, taking part, discussing the outcome. What can we do to make things even better? Well, if we add a capability here, then it's going to move around products. And if we tweak this thing here and da-da-da-da, it's a great, fantastic discussion in your teams that you have. And then eventually you're done. And then you see here, well, if you look at long-term cash flow, it's alternative 4 that is the best one. And that becomes your, if it's also something you can do, if it makes sense, if it meets all the tests that you make on sensitivities to see where you might be exposed and so on, that then hopefully becomes your so-called recommendation for action, which becomes the strategy for your assets to achieve your best company. It's a strategy that has been calculated, okay? Usually strategies are really abstract things, but this is a calculated strategy. You have numbers behind everything. So it's a strategy that you calculate, that you can motivate, you can backtrack. It's not a black box. You can see what's going on everywhere, and you're going to see that this is actually what you're going to do. And what happens then is magic, because then everybody basically in the company that take part in this process will say, yeah, this is what we need to do. We need to do this. And it's a process that might take you 3, 4, 5 years to implement, because it means that you are building a new line, you're planning to shut something down, and so on and so on. And that will be the strategy that will completely govern the Capex budgeting, the capital budgeting process, and the decisions that you actually make. It will be the cloud that is floating above these existing processes, where every decision you make must be related to this strategy. And the effects are very large, because the cash flow effect that you have long term from allocating capital year in, year out in a completely different way is magnificent. We're not talking 3, 4, 5% here. We're talking a lot more. It's usually between 20 to 100%. In a few cases, we've been above 100%, which is doubling the cash flow of a company, but that is unusual. But we at least 90% of all the work that we do end up improving a company's cash flow by 20 to 100%, something like that. So the effects from this is fantastic. You should compare it with being active on the stock market and figuring out a better strategy for doing that. You're going to see that money comes out from it, and it's the same thing here. This is also capital allocation, and again, we deliver this either as a consultancy process involving us as experienced consultants having done these projects for more than 20 years, or you implement this as a process with the tool that enables you to do this in a controlled way, in a very productive environment, user-friendly, and so on. And that is also, of course, something also that we do. And I'm actually done. I have taken this presentation as far as I intended to take it. Well, let me just say one more thing, just to connect the first part of my presentation with this last one is, what you're going to see when you have your recommendation for action here, the recommendation for action will be a combination of many Capex products. If you go all the way back here to this, you backtrack, you go into alternative 4 in this case, and then you follow these lines here and see, well, what actually are the building blocks that are part of this fantastic strategy. You're going to see something that is so strange, that if you were to look at these individual building blocks as isolated products, the way you look at capital today, you're going to see that they don't have a short payback. They might have, but they are typically not having a short payback. They're going to be all over the place. One is going to have 3 years, so that's great. Another is going to have 8 years. And then you're going to have a number of them that don't even have a payback, because that is, again, it is not relevant. Mathematically, it's not relevant, doesn't matter. We had a project that we delivered. It was a Capex Strategy product that we just did as consultants, that we delivered 4 years ago to a company. It consisted of 7 large building blocks. That recommendation had 7 large building blocks. And what was unique about that one was that none of these 7 building blocks even had a payback when looked upon individually. Okay. It is really counterintuitive, but to me, I didn't think that would ever happen, because that is an extreme case. I knew it could happen, but I didn't think it ever would. But that it confirms to me again that the way companies are evaluating products today, it is not relevant. It's not what's relevant. It's not what matters. And it's kind of disturbing, because it is basically how all companies on earth are doing this. So now I'm opening up for questions, if we had any more questions. Now Olivia is running the screen here. You want to stop? Yeah, hi. Now I can see myself, and we have a few questions here. Have you also worked and seen these numbers within the mining and metals? And that I answer yes. So we have been in mining and metals both in Europe and the Americas, and we have seen it's the same thing, because companies are applying the same processes. They themselves, they think they have a secret process. They don't want to show it, but actually it looks the same way everywhere, basically. Second question is if we have a website. Yes, we do. I showed it to you earlier. If you look at the logo up here, it's wiser.com. We have a lot of information there. You can also send us an email or something. You can also look at YouTube. We have lots of videos there explaining this and debating these capital allocation challenges and issues. So that's another way of gaining some information. Another question is, you say that short paybacks are bad. Does that mean that long ones are good? And no, that it isn't. What I'm saying is, again, that it's irrelevant. It could be short, it could be long. It doesn't matter. It doesn't matter. What your company should be doing from a decision point of view, if you look at that entire package, which is unknown, what it is you should be doing, those paybacks are, again, they're going to be all over. 1 year, 10 years, 20, never, it is, unfortunately, it is an irrelevant measure. Yeah, what is the methodology for getting a combined cash flow as a group of assets? Yeah, I think I need to spend more time on my last picture, the one with the building blocks and all these line combining things and so on, to explain that. And I don't think there's a fast way of doing that now. But we have a process, we have a methodology that we have applied for more than 20 years. We started out in the 90s in the pulp and paper industry, in nuclear, and since then we proceeded into other industries and refined that methodology so much. And also a process, so it's a method and process. And it's what we do is, I'm afraid, a bit of explaining details now, because it won't be done in a context. But we look, it's basically like a forward cash flow forward-looking cash flow statement, you can say, for each mill, split up in pieces, cost items, and in products, product grades, volumes, pricing, and everything. Long-term Capex forecast is done per line, per mill, per division into the corporate level. And then you simulate it back and forth using a specific way of doing so. So that's my short answer. Is the process on Capex budgeting the same for both the private sector and the government sector? I would say it is very much the same, but the demands at the end are a bit different, because you might not have a cash flow view in the public sector, in the government sector. It's more something that, for instance, that you need to supply all your regions with water, for instance. That's not about making money, it's about making sure that people have water. So that you have different demands, but the ways of planning, the way of selecting your projects, figuring out what you should be doing now and later, in combination with the risk, of course, which is always present when it comes to utilities, for instance. It is very much the same way, done in the same way. Oliver, did I have another question? No, so my main difference. Yeah, so we also work in government-owned type of businesses. We actually I just came out of a meeting discussing just that in a Swedish utility company owned by a city. So it is very much the same. Okay, so maybe that was the final question. Again, please connect if you have more questions. You can download more information also from our website. You can also connect with me right away. And I don't think we have my email anywhere here, but you'll find it. You'll be able to connect with us through our website, no question. And if there are any questions, just ask my Sorry, I can write. No, okay. So I hope I gave you an interesting. How long time did this take? Half an hour or so? 1 hour. And thank you very much. Thanks for your time.